High-return financial investments for common people. A comprehensive guide. Introduction. Investing is a powerful tool for wealth creation, especially for common people seeking financial stability, growth, and early retirement. While the investment landscape is vast and sometimes complex, many high-return opportunities are accessible to the average person with proper knowledge and discipline. The key challenge is balancing the pursuit of high returns with acceptable risk levels, liquidity needs, and time horizons. This essay explores various investment avenues that can potentially offer high returns suited for common people, emphasizing practical, accessible options. It discusses the nature of each investment, expected returns, associated risks, and strategic considerations to optimize gains while managing downside risks. Equity markets, stocks. Equities or stocks represent ownership in a company. Historically, stock markets have delivered some of the highest long-term returns among asset classes, making them attractive for individuals aiming for high growth. Why stocks for high returns? Capital appreciation potential. Dividends. Additional income, participation in company growth, suitable strategies for common investors, direct stock investment. Buying shares of companies requires understanding of fundamental analysis. Mutual funds, professionally managed portfolios pooling investor money, reducing individual research burden. Exchange-traded funds, ETFs, diversified investment options tracking indices or sectors. High-return sectors and stocks, technology and innovation-driven sectors, emerging markets, small-cap stocks with growth potential, risks and considerations, market volatility, economic downturns, company-specific risks. Practical tips: diversify across sectors and companies. Invest systematically via SIPs, systematic investment plans. Keep a long-term perspective. Mutual funds and systematic investment plans, SIPs. Overview. Mutual funds pool money from investors to buy diversified portfolios of stocks, bonds, or other assets. SIPs allow investors to invest fixed amounts periodically, smoothing out market volatility. Why mutual funds? Professional management, diversification, accessibility with small amounts. Types of mutual funds for high returns. Equity mutual funds, sector-specific funds, e.g. technology, healthcare. Thematic funds focusing on emerging trends. Risks and rewards, market risks impacting fund performance. Potential for high returns over long periods. Practical tips: choose funds with consistent performance. Review fund manager track records. Maintain a disciplined investment approach. Real estate investments. Overview. Real estate is a tangible asset that can generate income and appreciate over time. For common investors, options include direct property purchase or real estate investment trusts, or REITs. Why real estate? Potential for high capital appreciation, rental income, tax benefits in some jurisdictions. Accessible options. Buying rental properties in growing areas, investing in REITs via stock exchanges. Risks and challenges. Market downturns, liquidity constraints, management and maintenance costs. Practical tips: conduct thorough location and property analysis. Leverage wisely. Diversify across property types and locations. Fixed income instruments with high returns. While fixed income is generally considered safer, some instruments offer relatively higher yields. Corporate bonds. Higher yields than government bonds, but with increased risk. Debt mutual funds. Invests in a mix of corporate bonds and money market instruments. Tax-advantaged bonds. Certain government schemes or municipal bonds. Risks. Credit risk, interest rate risk, liquidity risk. Suitability for high returns. Suitable for conservative investors seeking moderate high returns. Not ideal for aggressive growth, but complementary to equity investments. Small savings schemes and tax-advantaged investments. In some countries, government schemes offer tax benefits and reasonable returns, suitable for risk-averse investors seeking steady growth. Public Provident Funds, PPF, National Savings Certificates, NSC. While these may not offer the highest returns compared to equities, they are stable and tax-efficient. Cryptocurrencies, the modern high-risk, high-reward asset. Overview. Digital assets like Bitcoin and Ethereum have gained popularity for their explosive growth potential. Why cryptocurrencies? Decentralized and innovative technology, limited supply, and increasing adoption. Potential returns. Some investors have seen 10x or more gains over a few years. Risks. Extreme volatility, regulatory uncertainty, security threats, hacking. Investment approach. Small exposure as part of a diversified portfolio, long-term holding, or active trading. Peer-to-peer, P2P lending platforms. Overview. Platforms that connect lenders with borrowers directly, offering higher interest rates than traditional savings accounts. Potential returns. Returns ranging from 8% to 20%. Risks. Borrower default risk, platform risk, regulatory changes. Suitability. Suitable for investors willing to accept higher risk for better yields. Gold and commodities. Overview. Gold has traditionally served as a hedge and store of value, and can provide high returns during inflationary periods. Investment options. Physical gold, jewelry, bars. Gold ETFs and sovereign gold bonds. Commodities trading, more advanced. Risks. Price volatility. Storage costs for physical gold. Alternative investments and niche markets. Art, collectibles, and wine have shown high returns in niche markets, require expertise and patience. Risks. Illiquidity, valuation challenges, market speculation. Strategies for achieving high returns. 1. Diversification. Spreading investments across asset classes to mitigate risks. 2. Systematic investing. Regularly investing fixed amounts, e.g., via SIPs, to average costs and reduce timing risks. 3. Long-term perspective. Holds investments through market cycles to realize compounding benefits. 4. Risk management. Setting stop-loss levels, avoiding emotional decisions, and balancing risky assets with safer ones. 5. Continuous learning. Staying updated with market trends, financial literacy, and sector developments. Risks, challenges, and ethical considerations. High returns often come with significant risks, including potential loss of capital. Ethical investing. Avoiding investments in harmful industries or unethical practices. Be wary of scams, Ponzi schemes, and overly aggressive schemes promising guaranteed high returns. For common people, high-return investments are achievable through a disciplined, informed approach combining various asset classes. Equities, mutual funds, real estate, cryptocurrencies, and alternative assets can offer substantial growth, but they require understanding, patience, and risk management. The key to successful investing is setting clear goals, understanding personal risk tolerance, and maintaining a diversified portfolio aligned with one's financial situation and time horizon. While high returns are attractive, they must be balanced with prudent risk management to ensure steady progress toward financial aspirations.